You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, Jonathan Rose, and welcome to Masters in Trading Live. Today, we're going to talk about the yield curve. The yield curve is what really moves the markets. When the yield curve steepens, which is straight up like this, where short-term rates are lower than long-term rates. Or we could have a flattening environment. In a flattening environment, all yields are pretty much the same, going out from 6 months all the way out to 30 years. So what I wanted to do today is I want to take you through the history of the yield curve and how it relates to the stock market. This is going to be one of those really important videos that I think you're going to end up saving and watching again. So without further ado, let's get into it. I'm going to start you right here with the screen share, Masters of Trading Live. We're going to do yield curve versus the SPX from 1999 to present day. This is going to be really, really cool. Now, why am I talking about the yield curve? Well, I've traded bonds professionally for 10 years. Bonds are a really cool trade. I know how to trade bonds. I know how to value the fixed income markets. And just to prove that to you, I put out videos every single day. And if you search how to trade options, Jonathan Rose, Masters in Trading, is not in the top 50 search results because there's so many people out there that are professional option traders that are trying to teach you options. But when it comes to trading bond futures, guys, I used to be number one in the world because I don't put too much content out about this. I have all of the top videos on YouTube for how to trade bond futures. This is something that I know really well. This is something that I understand really well. So please, be patient with me. Telvin, it sounds like we got a little echo. Just FYI, Dewart is talking about the echo in the chat. I'm going to keep talking. We're not going to stop because a little echo can't hold us down. All right, here we go. Now here's an overview. 1999 to 2000, okay? 2003 to 2007, 2007 to 2008. What I want to do is I'm going to go over each one of these, and then we're going to stop and we'll talk about them. So let me move this off the screen. And I'm going to start with 1999 and pause. Let me just explain to you what's going on. The right side right here, this is the SPX. This red line is where we're at. During that time, June 1999, this is the yield curve. Can I get a Y in the chat if this makes sense? This is the yield curve. This is the SPX. Once I hit start, it's going to show, look, time passing on the right and the yield curve on the left. Excellent. We're in 99 to 02. What you'll notice is the yield curve looks a lot like it does right now. This is what the yield curve looks like right now, guys. Okay, it's flat, flat, flat. Stress. That's why the market is getting hit, okay? Look at the shape of the yield curve. Now, the front of rates are coming down. There's going to be more shape in the yield curve. Let's get to 02, and we'll stop it again. Pause. Okay, so we just went through a time period from 1999 to 2002, right? We just went through a time period from 1999 to 2002 when the yield curve was really flat. The front end was trading above 4.5. But now we're in 2003, and now the shape of the yield curve is beautiful. This is called a normal curve. So I'm going to start it. Normal curve. SPX rallied like crazy because the yield curve is healthy. Healthy yield curve is supportive of equities. Okay? Look at that shape. Very low up front for a less amount of time. you're going to get a lower yield. The more time that you want, the more yield that you're going to need. And we did that from 2003 to 2007. Bull market, strong market, right? But look what's happening now, guys. Risk is coming into the market. You see that? Risk. Look at that. Risk is coming into the market. It's going to get worse. 2006, flat. Shit, we're going to start going inverted. That's a problem. I had the biggest year that I ever had in 2008. I made over $4 million. Why? Because if you've been in the business, when you see this, it's high risk. Okay? 2007, crisis warning. Curve flattened. It inverted again, signaling trouble. SPX collapsed as the financial crisis unfolded. But the bond market guys are giving us clear signals, right? Let's move on. Thanks, Eddie. Appreciate you, buddy. Why are you just writing Y? What does that mean? Someone just wrote Y in the chat. Now we're going to go to 2009 to 2019. Recovery and expansion. Remember what happened. The curve was dead flat, right? It was raising. It was flat. 5% in the front of the yield curve. 2020, we're going to run into COVID. And then 2024 to present, we'll take you to present day. Let's look at it. 2007, okay? Market's going to get killed. What's going to happen? They're going to drop the front end to zero, right? Watch it. March 2008. They have to rip these down. They need rates to get down. They need money into the system. Take it down to zero. Boom. Zero. The cost of borrowing gets cheap. Easy money now, right? You can borrow for 0%. Let's do it. You can borrow for less than 1%. Let's do it. The market, that's healthy. Love that. That's the shape that we want in the market. 2010, setting up for an enormous bull run, right? How healthy? How healthy? That's what we need to look like in order for the market to just run. They're actually going to take the long-term rates are going to end up getting hit as well. Let's scoot forward. Big bull market, right? Rates are getting down. Uh-oh. Again, look, guys. Look at that. Look at that. We're losing that lovely shape that we had earlier, right? That normalized yield curve. And right now, the front end is starting to go higher. We're not up at 4.5%, but the cost of borrowing is clearly getting more expensive. Let's keep looking. Risk again coming back into the market. We're going to go into COVID soon. COVID, obviously the world fell apart. The Fed started printing paper like they couldn't print enough. Took rates down to zero. Look at that. Money. Let's take it out of the Fed and put it in stocks. Boom. How long can we play this game? 21, September. Getting to the top right here. What do we see? Getting to the top. And now watch. Look at all those rates going higher. 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 But now look what's going on, guys. I just took you through the whole history. What do we know when the yield curve starts to get wonky? Risk, right? Risk is elevated. Elevated. Kind of getting concerning. Kind of getting scary. Now, we are right here. What's going to happen is I'll show you what's going to happen. The Fed wants that. This is what the Fed wants. So right now, if we're straight across here, politicians are fighting to get the front end of the rates down, right? The Fed does not move the back end of the rates. The Fed only moves the front end of the rates. So in my strong opinion, what's going to happen is the Fed is going to lower the front, but the back end is going to spike. I'm concerned that the back end yields are going to go much higher as those front end yields go much lower. That makes the whole curve look like this, very, very steep. But yeah, as Eddie points out, remember, when yields go up, bond prices go down. They have an inverse relationship. Okay? All right. I hope you learned something, guys. I'm going to share this. This is called Stock Charts. They have a really great dynamic yield curve that I encourage you to play around with, because right now we are beginning another tightening cycle. Who knows how long it's going to last, but what we want to do is go back and see how has the market performed when the Fed has moved rates in the past. All right, guys, that's what I got for you today. Thanks for joining. Please watch that back. It's really important information, and that'll set you up so you can anticipate what the Fed is going to do going forward. Guys, thank you so much. What I always do now is I drop off and we move on to our all access portion and go over some of our open positions. Our big open position, which is crushing right now, LYFT, lift to the moon we go. Thanks for watching, guys. We'll see you tomorrow.